Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. The stock markets have been moving higher despite interest rates holding steady and inflation still not where the Fed would like to see it. So can this rally on Wall Street continue? Also, with the markets moving higher, are stocks beginning to be overpriced? But wait, there's more, as they say in television. The economy is in trouble in China, and there are millions more retirees in this country than predicted. So what effect can either of those have on the U.S. economy and how you invest? That is part of the discussion in this week's edition of Around the Table with Stacy Smith. And here to discuss those topics and more is my panel of advisors and analysts. Let me introduce them to you now. And they are, first up, Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. Carrie has been recognized by Forbes as one of the top women wealth advisors in the country. Also seated at the table is Frank Rossetti. Frank is the managing director of HF Management Company, which is part of an alternative asset partnership. Frank's background includes 50 years in the investing field, and he helped to establish Harvest Financial here in Pittsburgh, where he was the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a dual background in both finance and in software engineering, and you may have seen Kim in her many appearances on CNBC, Fox Business, and also on Bloomberg. And there is one more seat at the table, and occupying that seat is Michael Godwin with the Fergasso Advisors. Michael has a solid career in investing and is the chief investment officer for Fergasso Financial Advisors. Again, this year, Fergasso Advisors is listed among the Barron's National Top 100 Independent Advisors. Thank you all for joining me once again for Around the Table with Stacy Smith. We have a lot to discuss today, so let's get right to it. To say the markets have been moving higher may be one of the bigger understatements of the year so far. To give you some perspective, the Dow is up nearly 10,000 points from the low it set 17 months ago, and nearly 17,000 points from the low it hit during the pandemic. The NASDAQ is also getting much, much closer now to a new all-time high. And the S&P 500 busted through the 5,000 mark to set a new all-time high. And all three of the major indices are on a 5-week winning streak. Now, my analysts have always said you can't predict where the markets are going to go, up or down or just even holding steady. But I do ask this question to Michael. What could stall or even stop this rally that we have right now?
Thanks, Stacy. I'd say first that simple gravity could probably bring the stock market down a little. Stock market performance, when you think about it, is really just a function of two things. One is the earnings of companies, right? Are companies doing a good job of growing their earnings? And this is what really matters over the long haul. And second is valuations of companies, or how much are investors willing to pay to own stocks? And this is what can really move stocks drastically up or down intra-year. Now, the rally we've seen over the past year to date in the past 3 months has really been driven entirely by valuations, not earnings. So by some measure, stocks are pretty expensive currently. And I think the second catalyst that could drive stocks lower is just a broad-based slowdown in the economy. And this is what I thought would have already happened by now. I know I sound like a broken record over the past 6 months, but the Fed's goal of hiking interest rates by as much as they did was, in fact, to slow down the economy and actually create some unemployment. Because historically, that's been the fastest way to tame inflation. And that just hasn't happened yet, right? The economy hasn't really slowed down all that much. Companies are continuing to hire at the moment, and unemployment is still close to a 40-year low. So if most people who want to work, they continue to have jobs, then they're able to keep spending and they can keep the economy humming along. But if layoffs do materialize, I think that could certainly weigh on the stock market in 2024.
Who else would like to jump in on this one?
Well, I'd love to, but the one of the reasons I believe that the higher interest rates hasn't impacted the economy so much is because the incredible amount of stimulation that's been poured into the economy by 3 bills. Most recently, I think the infrastructure bill that was passed and the green energy bill, I'll call it. Okay, I just read today that it looks like about 300% of what they anticipated in tax credits over 10 years is what they now anticipate. So there's a lot of green energy stuff being built, which is a stimulus to the economy. Also, we're building bridges and roads and what have you, and that money is just beginning to filter into the economy, and that'll show up more in the next few months as the weather breaks. If we actually have weather anymore in this country other than rain. And that being said, I think that, and then the third thing is 5% is not a high interest rate. So I'm not sure it's going to slow much down. I mean, 8% is a high interest rate, 7% is a high interest rate, 5 is not. It's kind of normal. So what I think is that the inflation back has been broken more because the supply chain issue has gone away and because we've come with alternatives to Ukraine and whatever. And we've gotten that fixed and people have gone to work. So the factories are actually moving along instead of getting shut down for weeks at a time because of COVID. So, I mean, I think that the interest rate thing was, it's the only tool the Fed has. And it seems like it worked, but I'm really not sure that's why inflation has been coming down. It's probably why it's not coming down further. And I'm going to say this not because I intend to predict anything, but it may be to get it down to their 2% target, they might actually have to raise them a little bit more.
I was just going to bring that up.
I doubt that, but it's not out of the question.
Carrie, Kim, go ahead.
I have to challenge Frank. Frank, please don't tell me they're going to do any more work on Route 28. We need a break here. No more, no more money. Do the damage to some other place, okay? But seriously, so I have a couple of issues. I know I'm crazy. I know I have not been steeped in the world of economics and econometrics, but I'm a math person and I look in the past and I say, has the growth of the economy created inflation? And I'm going to have to say no, it has not. If you look at times between, let's say, 2012 to 2019, we had a growing economy and inflation was very tame. In fact, the Fed had the opposite kind of concern that, we didn't have enough inflation. So the Fed trying to use the interest rates to slow down growth and thus affect inflation doesn't seem like that might have a direct linkage. I mean, if you crash the car, sure, it's going to come to a halt. And if you would raise interest rates high enough to crash the economy, of course, we would get, have a slower growth rate and we would have that much wanted unemployment, right? And that should slow down spending. But that being aside, I think a lot of it has to do with the growth of the money supply. And the Fed is actively using quantitative tightening to try to keep that under control. And I think we'll be able to see that increase throughout this year. The other problem, quite honestly, was the supply chain was horribly, horribly broken. And people had direct money in their pockets and were buying things at inflated prices, like cars, right? And that has kind of come down. And I think we're really beginning to see this. And on Tuesday of this week, we will have gotten the information from the government to see what CPI is. And I'm going to be watching that closely. And then retail sales is later this week. So we will actually get to see how the economy and prices are performing. And that's all I have to say about that right now.
Okay, good. Carrie, can you wrap this up for us?
Yeah, I'll be kind of short about it. Like, the economy's doing well. It's very hard for people to actually accept the fact that the economy is actually doing well. We want to make excuses for it. We want to try to predict when it's going to go down. But at the end of the day, the biggest issue, which is employment, has been strong throughout. So I'm not really surprised that the market has been responding, but that's a look in the rearview mirror, and we'll talk more about our predictions coming up.
Okay, great. We need to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. Michael just mentioned this a moment ago, so I'll bring it up. With the markets on the upswing, it leads to the question as to whether stocks might be overpriced. So, Kim, I'll ask you this question. what might be the best way to try to determine if a stock is priced right?
Oh, this is such a hard question to answer. And I'm going to kind of give you a wobbly answer. But this is the true answer because I've been looking at stocks for the past 25 years. This is exactly what I do, is I try to put money to work in areas that are unloved and a little bit underappreciated, and then be able to harvest whenever they are appreciated or maybe overappreciated, right? So what I have found is there is no one metric to look at on an individual stock basis. And, we could talk about, is the market overvalued? That's another question, but I want to answer what happens when a stock is overvalued? Or how do you know it's overvalued? The best way to do this is to compare some metrics, some ratios of stocks that have direct comparables, right? Whenever I just want to lose my mind completely, whenever I hear Apple or whoever's hot, let's talk about NVIDIA, that their price to equity or price to earnings ratio, PE ratio, that's price divided by what their anticipated earnings are. We always look forward earnings, not past. Whenever that's compared to the market, like, who cares? You have to look at it compared to other chip manufacturers or chip designers like they are. And you have to then look at what their growth rate is and how likely that is to continue. These are the markers that are going to tell you whether an individual security is overvalued, at valued, or undervalued. And again, there's going to have to be some imagination used here because we always want to know what's going to happen in the future. We don't really care about what is in the past. So these are my big things that I look at, and I'm sure the other panel members have their favorite metrics.
We've said a couple of times that things have to be looked at from a lot of these things are driven on the long term. On the short term, because the market has run so far so fast, and it anticipated interest rates dropping quickly soon, and it's more likely they'll drop slowly longer. It wouldn't be shocking right now to see a correction in the market, which by my perspective is a good thing, not a bad thing. It creates a buying opportunity because I don't really see the economy slowing down much in the foreseeable future. And I don't see earnings not growing. The question is, how fast will they grow?
So I have to laugh a little bit about, Frank used the word buying opportunity. Having been in this business for, way too long, 35 plus years, when markets go down and you tell someone it's a buying opportunity, they'll say, oh, you people always say that. And I always say, well, to date, we've always been right. Like, right?
Right.
We're sitting here at all-time highs. So maybe there's something to that. But along the lines of what Kim was talking about, I think that, it is important to realize there's more than one way to understand the valuation of a stock. Our approach is a little bit different. I actually tend to like to look at trailing earnings because future earnings really is dependent upon management. And so, and I believe that, and for me, management and management's ability to execute is most important. And these metrics help to filter into those decisions and looking at where's the company now? Do I believe in the management? Because those future earnings may never happen if something else is going on. And then from a bigger picture, it's also the environment. Like, that's where, when you look at what's going on around the world, it might be a great company with great management, but if something is going on that's going to impact that sector or that industry, then you have to connect the pieces. And that's, the difference between a bottoms-up approach and a top-down.
Michael, you also are in the business of trying to select what stocks for the clients of your firm. So tell us your thoughts.
Really quickly, I'll do my best. I like what Carrie brought up there because she's talking about investing and not really trading, right? When you invest in management and you invest in a company, sometimes you don't even look at what the valuations are all the time. I mean, it's important to do that, But when you're investing in a company and the management, then over time, over the long haul, they should make the right decisions and you should be rewarded handsomely. We look at a number of different valuation metrics, not just price to earnings, as Kim brought up, price to earnings to growth. We look at price to free cash flow, all these different things to look at it. And I like what Kim said. You have to look at the comps, the comparables. That really, really helps as opposed to looking at NVIDIA, as Kim mentioned, to the broad market, because NVIDIA to a utility company means absolutely nothing here. So looking at the comparables, I also think, I want to reiterate that is very important. And the last thing I'd point out, Stacy, is valuations are not at all a good predictor of what the stock market is going to do over a 1-year period, maybe even over a 2-year period. They are, however, a pretty decent predictor over a 5 to 10-year period. So as Frank mentioned, buying on a pullback when valuations get cheaper, and as Kerry pointed out, that is actually not a terrible way of investing over the long haul.
All right, great. We need to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. The baby boomer generation is getting older and more of them are retiring. In fact, there are now nearly 3 million more retirees in this country than was predicted. So, Kerry, will this have an effect on the economy and thus on the stock markets longer term?
Well, it's interesting. This is a subject that's been around for, over 2 decades. Back in the 90s, there was an author, you guys can correct me if I'm wrong, I think Harry Dent wrote a book called Age Wave, which talked about demographic trends and the growth of the baby boomers and how that was going to push the market up. And then either he wrote a book or Ken Dykewald, which I don't know, was like Boom to Bust, which talked about this specific subject about the aging baby boomers. So, this is not a new topic, but I think that what wasn't included and what wasn't understood, which is what makes our industry so fascinating, is that things change. And with the impact of technology and the application of technology, we are in a situation where we're a lot more productive. So people retiring, you assume they're going to spend less. And that may be the case, but we've created a lot of wealth. When you think about the market, the reason why we're 3 million ahead of where we thought we would be is because the market has had a really big boom and people can afford to retire. So the retirees that I know, they're not sitting at home. They're out traveling, they're out doing things, they are spending money. So it's something to keep our eyes on. I think that the bigger concern I have about retirees goes back to employment, right? The demand for workers and what kind of longer term implication does that have to an economy? Is that just an inherent driver of inflation? Because we're going to have a lot of people out of the workforce, less people coming in. How do you balance that supply demand? So that's something that we're keeping a very close eye on.
To add to that, a year or two ago, Stacy, you asked me what I thought you asked all of us what we thought the biggest problem the United States faced. My answer at that day was the lack of people. The good news is last year, we didn't naturalize, we gave green cards to 1.2 million people in this country. All right, those are legal immigrants. There's another guess that there's 500,000 or so illegal immigrants that came into this country, most of whom are working. And that may be one of the reasons why we have this economy continuing to grow, because when they make money, they also spend some. They don't send it all home. They send most of it home, but they actually spend money. They buy food and what have you. And hopefully they'll move into the service economy well enough if this continues. And our problem of a lack of employees will diminish over time if we ever get a logical immigration system up, because somebody quoted a statistic that I'd never heard before, that I heard last week for the first time, that 1/3 of economic growth is created by immigration. And that's a long-term statistic, the way it was implied. And if that is true, then we have to get this thing rectified so that we're actually allowing people to come in. The people want to come into this country. They don't want to go to China. They want to come here. And there's a reason for that. This is a great place to live. We all live a pretty decent life. Our clients live a pretty decent life. Most of the people I run into every day live a reasonable life. And that is not common in the world. That's why our borders are getting crushed. We have to figure out how to let them in because we need them.
I'm going to reiterate Carrie's idea on technology. I think that is key. And I also think a client reached out to me about something that Harry Dent wrote recently. He is apparently the worst ever, strategist. And if you do the opposite of what he says, you're going to be like, okie dokie. But that's just that. Anyhow, back to technology. I mean, we really do need it. And we probably for the past 10 years, we really haven't done much in the way of productivity, enhancing big picture kind of technology investing. It's been more, having Amazon deliver stuff to your home, which kind of is productivity enhancing, but I'm talking about businesses using technology in novel ways. And I believe this AI thing is for real. And it will be able to enhance our lives if we don't let it get out of control, which we shouldn't. We're just not going to say, sure, here, robot, do all this stuff. But it can help us very much become more productive.
I don't have too much to add, Stacy. The only thing I'd say is it's more ethereal than anything else is we have about 55 to 65, I think, million retirees here. And you mentioned 3 million more than predicted. Those people will have to draw down on their stock market holdings and their bond holdings in order to live. So again, I don't think that's going to impact the stock markets all that much, the fact that they're draining their accounts to live upon. The only other things I'd mention are, I know I'm not a doomsayer, but do I get concerned about entitlement spending a little bit? I just heard this weekend that the interest on our national debt now exceeds our overall defense spending. At some point, those could weigh on the credit quality of the U.S. government and force interest rates higher. If that happens, again, nothing operates in a vacuum. That could weigh on the stock market long term. These are all minor points that worth us keeping an eye on to see how that would impact the stock market longer term.
Yeah, you raise a good point here, and that is that if there are more retirees, they're going to take their Social Security one way or the other, and that is going to make a drain there. And then what kind of an effect does that have on the economy? And that's kind of what you're saying.
Yes, sir. I mean, I don't have much to add there. I think those are all little things that can matriculate over time that could just impact the economy and the stock market. But again, those are all more nuanced. The economy is so big that I think these little things in isolation aren't going to impact it at all. But you can't look at everything in isolation. You need to kind of think about these things all in totality. So, certainly more to come on that. We've been talking about the debt and entitlement spending for decades now, as Carrie pointed out. At some point, that's going to come home to roost. But again, I don't think it's going to be an impact in 2024.
Understand that I've been listening to this concern I bought my first stock in 1961. All right. I mean, that was 60 some years ago. And I've been listening to this national debt problem since 1961. And I am sure it could become a problem. I think that you have to look at the entitlement thing, though, a little bit differently. The baby boomers the front edge of the baby boomers are 77, I think, this year. And the facts are the average person dies at about 77. So the average baby boomer is going to start to die off here pretty soon. And the next generation is smaller. And the last of the boomers, I think, are about 62. So they're going to take their money in about 5 years. So in about 6 years, the boomer impact on entitlements should flatten out, maybe start going down. I'm not an actuary, but I would say that I'm nowhere near smart enough to be an actuary. But I think that the entitlement thing, we're getting near the end of that problem in this cycle.
Okay. All right, we have to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. You don't hear that much about it, but China's economy is struggling to the point that it is now dealing with deflation. So, Frank, does that present a danger for the U.S. economy or even the world economy?
Earlier in the show, Mike said that nothing exists in a vacuum, and that includes China. I think that the last 5 years of approach towards China has lessened their impact on us, but nonetheless, if they don't get their house in order economically, it's going to impact Southeast Asia and other countries that they do a lot of business with. And that ultimately will impact us. How great an impact will be, I can't tell you. I don't know. And I think that, but there will be an impact. Fortunately, it's not like this is a lightning bolt coming out of the sky. We can see this coming and we can adjust to this as we go. And I promise you that the businessmen of the world who live to adjust to what's happening are adjusting, and that will ultimately drive employment where it needs to be driven. It will drive consumption where it needs to be driven. And I'm quite frankly not worried too much about China because I believe this economy can adjust to anything, especially what it sees coming.
Anybody else want to jump in on this one?
I'll jump in if that's all right. I actually think that disinflation or outright deflation, which you mentioned, Stacey, we're seeing in China, has the potential to push down inflation rates worldwide as Chinese exporters kind of cut the prices on the goods they sell. I actually looked at this earlier. Prices of Chinese exports have actually been falling at their fastest rate since the financial crisis now. In China, you mentioned they do have a problem over there, on certainly in the stock market standpoint. And the Chinese government, they know that. They're trying to address it now to bring back investors, domestic investors, into the Chinese market. The past year has seen the U.S. stock market increase. I think the S&P is up about 25% over the past year. China's down 22% over the past year. It's quite a big divergence in the two worlds, the world's two biggest economies there. We talked about valuations a lot in this program. The S&P 500 is trading at 25 times or 24 times price to earnings. China's at 11 times price to earnings. So about half the valuation of the U.S. stock market. Now, this is not an ad to invest overseas, but history does go to show you when you invest in times of market turmoil, sometimes it's not a bad time to be putting money to use over there. Again, I'm not advocating for that, but it's certainly it's a good time to start poking your head overseas a little bit in those emerging economies to see if it does make sense investing for the long haul over there.
Michael brings up a really good point because for us, it really is about how we allocate client assets, and we're not restricted to only be investing in U.S. companies. So when we look around the world, like we have to ask ourselves the question in the U.S., what's the value of lower exports or lower imports coming in from China? But then again, what's our relationship with China in terms of imports? And are there other countries in the world that may have a different type of relationship that may benefit from some of these things? So, you know, when we're allocating dollars, we want to look around the world, and that includes emerging markets, but it also includes kind of that secondary, what about other developed countries around the world that may actually benefit from what's going on in China, where they are in their economic curve. Because you have to remember, you know, the whole idea is to buy low and sell high, not wait for everything to get rosy before you start to take those steps.
All right, Kim, we don't have a lot of time, but I will ask you this. Is it more difficult to try to analyze a foreign stock than a U.S. stock?
Absolutely. And I urge caution on anyone who is going to do a direct investment. The biggest issue here is the accounting rules. It sounds crazy, but other markets allow and even encourage insider trading. Wait, what? Yeah, exactly. So you don't know what the rules are over there. And that is why I always suggest if you want exposure to an area, you use a mutual fund that has people that are domiciled in that area and understand the accounting rules. Don't overlook that at all, ever.
All right, great. Well, we have now run out of time. There's a lot more to discuss on how to manage your portfolio, and we will do that in the upcoming session. So once again, I want to thank Carrie and Kim and Michael and Frank for being with us, and we hope to see you the next time on Around the Table with Stacy Smith. Thanks for joining us.